founders in general, you have to have obviously the conviction, but some level of delusion.
I'd be shocked if the word "some" needs to be there. I think like a pretty healthy amount of delulu. Hi, everyone. Welcome back to the Data Minute podcast. My name is Peter. I'm the head of insights here at Carta. And on today's episode, I was joined by Aditi of Upfront Ventures. Now, she is someone I've respected for a long time when it comes to her views on the seed and Series A market in particular, which is why I had her on, because there is a moment happening with seed stage companies right now, and it's not a good one. Now, there are a ton of seed stage companies out there who are getting bridges or extensions or otherwise creative forms of funding just to tide them over because they're not able to raise their Series A round. And why aren't they able to raise? Because the Series A metrics they need to fundraise from those investors have shifted completely underneath their feet. We began our conversation by talking about seed stage dynamics all across the US, in particular Upfront's home market in LA and their growing base here in San Francisco. We, of course, spoke about the topic of the day, which is AI companies. Now that everyone has billed themselves as an AI company, how do you as an investor decide which of these companies are going to go the distance? We talked a lot about grit, both in Aditi's investor profile and also as one of the main qualities that she looks for in her portfolio founders. We rounded off this conversation by touching on our speed round questions. I was particularly impressed with her answer to what is the most unique thing you've ever done to help a portfolio founder. Let's jump into this conversation. Aditi, thank you so much for joining me today.
Thank you for having me. I'm excited to be here in the Carta studio.
You are here before your good friend Jane Alexander, my old CMO. I know she'll be annoyed by that, but I just wanted to give you the opportunity to say hi to Jane.
Hi to Jane. We love Jane. Jane is one of the greatest and hopefully will be on your podcast soon.
I cannot wait to have her on. New investor. I'm sure you've been teaching you the ropes.
Yes. I think she's going to be teaching us a lot very soon, given that the stage at which she's at.
Totally. The growth rate is pretty amazing.
Yeah.
But you are a partner at Upfront Ventures. Why don't you give us a little bit of background on Upfront and the deals you're currently investing in?
Yeah, absolutely. And so I think everyone always thinks of Upfront as an LA-based fund. Good news is we are an LA-based fund, but actually we do happen to have an office up in San Francisco, which I opened 5 years ago. That was 2019. Then we closed the office in 2020, and then we reopened office. Now we're down in South Park, or in the South Park area, which has been great. I think historically, the best way that I can describe what Upfront has done, which we've stayed true to, is we're your first institutional check. We're sort of the earliest stage investor. Now, the term first institutional check has also obviously changed.
I'd say that's undergone a vast change over the last 3 to 4 years.
Absolutely. And I think there's been the creation of a variety of different subcategories. I always like to describe what we do is we are early stage investors, but primarily focused on seed. Now, what is the seed? The pre-seed, the early seed, the big seed, the seed, the mango seed.
Mango,
can do all
strawberry.
seeds.
Why did we add the fruits in? I think it actively makes it more confusing.
The mango seed is, I think, the largest seed there is.
I should.
As a fruit. That is, I think, my hypothesis.
Okay.
That I think I've been told.
So it is the biggest of the seeds.
It is the
biggest of the pre-seeds.
Of the
actual seeds.
Of the actual seeds. Yeah. And so we get to do that, and primarily keeping our focus on the earliest stages. What it's allowed us to also, what we as a fund also kind of focused in on is every partner at Upfront has, I would call it like majors and minors or focus areas. And so categories that they spend most of their time in, going really deep, whether it is things like one of my partners, Nick Kim, spends his time mostly on hard tech. So space, deep tech, things of that category. My partner, Kevin, spends his time on healthcare and gaming, and now spending a little bit more time on dev tools and infra. I spend most of my time in B2B software as well as fintech. And so kind of keeping our focus a little bit narrower allows us to sort of build deep networks in those categories, whether in San Francisco, whether in New York, whether in LA, kind of pretty broad across the United States in general. Most of our deals are obviously US oriented. And then I would say what it also has allowed us to do is kind of build that muscle to sort of be a specialist in a generalist fund. So the example I think of is, as over time I've built up networks in B2B software as well as in fintech. I have met I think I have the ability to sort of map who are the angels or the pre-seed funds who are spending time investing in this. That's kind of my inflow of investments, as well as, the operators at the top 10, 15 B2B software and fintech companies, and being able to tap them and sort of know when they're leaving to start their next business or to start a business.
Is that network formal? Like, are you writing this into Affinity or Airtable or something, or is it mostly in your head?
I would say we've formalized it, actually. Okay. And so we work very closely with our talent team. Many venture firms will tell you they have a platform team, and sort of the question is always, how much are you leveraging and working with your talent team? Yeah. I really do feel like our talent team in particular is sort of like they're like our secret weapon in a lot of ways. I think they do a great job in helping us sort of track talent, also surfacing talent in advance of when we would go out and track. Right. And then as we think about working closely with our marketing team, building the Upfront brand, which we can talk a little bit more about, is sort of a critical part of what we do in establishing who we are, what do we do, why do we do what we do? And so much of the people that we find are important to invite to events we curate, to dinners we host, and we'll have like product dinner series, which is something that I do very closely with one of my portfolio company CEOs, the CEO of a company called Arcade. The founder's name is Caroline Clark. She and I host, a product leaders dinner series.
We're big fans of Caroline here.
Yes, totally. I think Carta is a customer. And the value and advantage that we have of our talent team formalizing the network development work that they've done is they are surfacing leads for us, not just to source, but to have at events, to have it within our community. And then each of the partners at Upfront is spending time sort of curating that, building that. And then obviously these companies want to go get funded, and or companies in our portfolio specifically want to go get funded. And so we want to make sure that we are also introducing them to the right downstream investors and making sure there are people around the table, whether it's like, the best B2B software of Series A funds. Who's still doing that? Are we all? Are
there Series A? I'm sure that there are many people listening that would love that list.
Totally.
You're happy to share it.
I'm happy to share it afterwards.
It'll be in the show notes.
But I do think that is a little bit of the work that we do very closely to sort of, I would say, sharpen our skills. At the end of the day, an early stage investment firm is mostly focused on people. Yeah. And you're making people-based decisions. And it's obviously people plus markets. And in coordination with that, if you aren't working closely with your talent team, and if you could either do it yourself, or you hopefully have a team of folks, which we do, who kind of take on and join us in this journey of like sourcing, curating, and identifying talent early. I'd also add that because we've built these like focus areas, I don't have to spend time. It allows us to be a little bit more collaborative in that if a deep tech company comes my way, or if a healthcare company comes my way, I immediately know who to send it to. Sure, yeah. And if Nick's sort of like, hey, Aditi, this like space tech company is actually doing like workflow automation for spaceships. Don't even know if that exists.
Small market, but we'll look into it.
Well, here we are. He'll sort of be like, I'm sending it over, or I'll send it over to Nick, and he's like, hey, I want to loop you in. Yeah. So we're able to tag team and move a little bit faster.
And other articles that you're investing in, like those sector focus areas, are those driven by your innate interest in those areas? Or is it, the firm gets together and they say, look, on a holistic basis, we think we're light in this place. We need to go find someone who will be there.
It's a combination. I wish I could say it was like one. Like, I just knew fintech, right, and therefore I was the expert. The reality is I've spent time in fintech prior to joining Upfront. I had been a product manager working on a fintech product. I've spent time, and therefore, okay, I also had personal interests. Great. Now, B2B software more broadly, for me, it is a combination of almost every one of the companies I've invested in has been a B2B software company. Sure. And the second is, as I've built more reps, you are able to kind of just like develop the natural understanding of like what works, what doesn't work. The good news is I have two other partners, Kobe Fuller and Mark Suster, who spent their entire careers building and growing B2B software companies and sitting on board. So it's not me alone. We get to do it together. Now we do pick our criteria based on I would call it like strategy sessions and partner offsites that we do internally. Sure. And at the same time, we spend quite a bit of time talking through what are new categories that we should be adding to our repertoire or adding in. And I'll say, as Nick joined Upfront, none of us had spent individually a ton of time in deep tech, but space and sort of like things in and around defense have started to rise as a category that is inherently innate to LA, which I think feels pretty advantageous to us, and that we do have some kind of geographic advantage over many other players.
You have an outpost in the Gundo now.
You know, it's funny.
Straight from the Gundo.
I personally just flew in from the Gundo. I took a spaceship over. But yeah, like I think that Nick and some of our colleagues down there spend a lot of time, you know, getting to know founders in and around that ecosystem. But there's a lot of great founders not in the Gundo.
Sure.
You know, and I think, but there's a ton of space companies down there. There's a ton of defense companies, and we're just seeing like I would say like deluge of founders leaving, wanting to start new businesses and asking like, hey, should I be flying up to San Francisco? It turns out actually there's a lot of Bay Area funds that have outposts in LA, and founders and VCs are meeting in the LA ecosystem. So it's been great. But that was like
as nice as you're going to be to LA.
but that I think is a big part of where I would say the geographic edge really plays a huge advantage for us. Healthcare is a similar one. Gaming is a similar one. With B2B software, you could be investing anywhere in the world. At this point, we're like investing in the cloud. We're investing wherever the hell we want to be investing. And so I think that's something that I'm just so aware of, that we want to have geographic dominance in categories where we think that we have advantage, and we've built deeper networks that are local. But for broader categories like B2B software, fintech, even beyond that, we think that it's worth having like more of a distributed mindset. And so that I'm based up here. I will also say I'm down in LA probably once every 2 weeks. So I do spend a lot of time and have connectivity down there. So that's like a very long answer to your first question of what is Upfront and who are we?
That's fantastic. Maybe to pick at one of those threads, which is this idea of, you know, you go to a leadership offsite or a strategy offsite and you say, which are the categories that we need to be more invested in, or the things that we're up and coming? I'm sure a year ago, 2 years ago, 3 years ago for you all, that was AI. It was on everyone's calendar. What do you think has changed about investing in AI companies over the last 2 years as we've gotten a little bit more into this boom? And it doesn't seem to have relented yet. But how has the investing into those companies changed?
Well, so it's funny that you bring that up, because I would say that we did not sit back 4 or 5 years ago and say like, we are investing in AI companies. I would almost say, then we talk about this all the time very openly with our LPs, we've been investing in sort of machine learning businesses for a long time. It would be 15 years, 16 years. I mean, one of our, an investment that, you know, has been in the Upfront portfolio for a while, and one that we're really excited about, a company called Zest AI, has been building models to help remove biases in lending, and starting with mortgages and looking at moving into personal loans, moving into auto loans. And it's really to like reduce as much bias in the lending systems that exist, and they're selling to credit unions. And I'd say we've been investing in machine learning forever and ever. What has changed is now every company has put themselves as AI because there's enough, like, you know, Mark always gives this analogy where he's like, investing is like kids playing soccer. There's kids splattered all over the soccer field, and the ball moves in one direction, and every kid is running to the ball. Nobody is staying in their position. Nobody is watching where the ball gets passed to, is making sure that they've got it. They're all kind of rushing towards what they think could be their opportunity to take over. Here's the thing. I think with venture, there's enough herd mentality. The best funds that have performed have been ones that have like kind of stuck to their theses, kind of stuck to their areas, and stuck to the categories. Now, do I believe that AI is here? Absolutely. Do I think that we should be investing in AI companies? Absolutely. But I think that at least where I spend most of my time, is around AI applications and sort of like the integration, the AI as an enabler to sort of create, you know, better collaboration, create unique data sources, create differentiated data sources to then create better applications, whether it is for customer support, whether it is for product management, whether it is for decision making, whatever that may be. That is, I think, the application, or what I like to call the applied AI layer, that I would say I'm spending more time in. What's happened is we're all chasing, or many people are chasing the ball, going to sort of where they think, you know, if you didn't invest, you're missing out. If you do, and if you're holding off and you're saying like, oh, I'm too cool to invest in AI because I don't follow the herd, then you may miss out on massive opportunities too. I think as a VC fund manager right now, especially as you're leaving and starting your own fund, or even if you are establishing and building out the sort of established brand like an Upfront brand, is how do you make sure that you are addressing current trends? How do you make sure you're investing in those and your existing portfolio is actually incorporating some of these existing trends, but you aren't straying for what you stand for? I think most venture firms don't have enough of a flag of like claiming what they stand for and who they are and what they believe in. And I think that's something that like hopefully we're making a change towards. I think more venture firms are coming out and saying like, you know, funnily enough, more venture firms are coming out and saying we're an AI first venture firm, which great. Does that mean you all want your jobs replaced by artificial intelligence?
Yep.
I don't think that's the case, but I think that we are asking ourselves a little bit of the question of, if you're an AI first organization, it's kind of like saying you're a mobile first venture firm.
Yeah.
It's almost like it is ubiquitous. AI will be everywhere.
Right.
There will be applications which will be more interesting to some people versus others. And right now, obviously, as you know, the ball has been, or the herd has really been around infrastructure. And I think the bigger opportunity will be, what do you do with how does the infrastructure sort of enable the ease of development of some of these applications?
You're waiting for the Uber to come along in the mobile era, which is just applied mobile.
Sure. Yeah. I would also say it's funny because in AI, I always think about the iPhone when it launched. It launched with the calculator app.
Right.
And it was like the daily use, like you would have a reason to open your iPhone, you'd have a reason to use it. Because the mindset shift to why would you need to be connected to the internet at all times, and why would you use an iPhone all the time, was fascinating. Like we had like little Blackberries where you'd like connect to the web and be like waiting there to open email or something, right? And then the iPhone came and the paradigm totally shifted. And I think we're now in a place where we've kind of seen these like, you know, I would say that there's like some of the toothbrush test applications, some of the calculator apps for AI on the consumer side. On the B2B side, those exist, but we're still spending so much time and so many dollars are still going into infrastructure. Yeah. We really do need the Uberification of it.
That's fantastic. I think AI, I mean, in our data, you know, when I talk to VCs like yourself, like they're saying, 90% of the pitches that we get these days have some sort of AI in it.
Interesting.
But it does seem that the shift is happening where it's not like someone splashed the word onto the front page and then didn't connect it to the rest of the business. It's more, this is a new technology that our team has taken advantage of. Yeah. And because of that, we have an opportunity that didn't exist before, which seems more rational to me than just, it's a hype wave, it's going to peter.
That's spot on. And I think companies that are spending time saying, we will not use AI or are not adopting it at all are probably completely missing the wave and are, you know, choosing to step out of the ring. Yeah. You have to be able to adopt new technology and you have to be an active adopter. I'll give Arcade as an example. Arcade is not an AI first company, but they have launched so many AI features and AI has enabled them to not only increase the launch of their own, like the time, reduce the time to launch for them. It's also increased the adoption of the feature set that they can offer. It's allowed them to basically do things that they weren't necessarily thinking about before, that suddenly people are like, oh, wow, like Arcade can do this much faster than we expected it to, or Arcade did this for us. They were more of like our go-to-market product, and now they're go-to-market with these like additional feature set that actually is really great for onboarding users in our product and things of that sort. So I think integrating it into your workflow is absolutely essential. We have to be open-minded to it. The thing about founders today too is like, I think there's some aspect of, there's the founders who are in, so I bifurcate the founder market, and this is kind of taking us on a different journey a little bit, but
let's do it.
Basically there are founders who are Valley people who have been working in and around big tech companies.
Silicon Valley,
exactly. And they spend a ton of time thinking about like, you know, what I think the next wave could be. And AI is maybe something that they've all heard about. Now, if you're technical, you've built infrastructure, you probably know what you're doing, you're probably going to go off the races. You've probably already been funded by Khosla or Sequoia, right?
Congratulations.
Exactly. But the flip side is there's a ton of people who are building and doing really interesting things in Silicon Valley, but also like broader in the US in general, in other parts of the world. And it's the first time that there is this like, I think this happened probably with crypto, and I wasn't as engaged on crypto as a subject matter, but the world is starting to seem more connected. There is this like general theme that everyone is somewhat interested in the progression and the success of this technology and the overall adoption. It's the same way in which there was that paradigm shift with mobile. There was the paradigm shift with like the internet. We have all kind of, everyone is interested. Everyone is intrigued. Everyone is seeing it. The funny thing, I'll give the example. We were on a family vacation last summer in Italy, and my dad, who lives in Singapore, was using ChatGPT to ask a bunch of questions on like the cities we were in and like the towns we were visiting. And like, there's something about the accessibility of it that, which again, kudos to OpenAI and what they've done. But even kudos to some of the other companies that are coming out, Perplexity and many others. Like, I think the fact that people are getting access, the best part about what AI has done is getting you access to information that you didn't already feel like you had through search or through the Google, through, Chrome or whatever it may be. I think that in itself has kind of like broadened the horizon of like the adoption, the greatness, and why in some ways like so much of the world is now feeling more connected. And there are founders all over the world. Like I was just sitting with a founder yesterday who's in Bangalore, who's building like a decentralized, or is trying to build like a decentralized data storage and social network, not using the blockchain, but potentially thinking about it through like, different ways by which AI can enable it. Who knows how the company ends up going? But my point being, I think we are all talking about it, thinking about it, investing in it is getting harder. I think in the infra layer, you do have to be technical, or you have to have some technical understanding. I think those valuations, and I'm curious if you do have data on that, probably have spiked and have probably stayed at the highest. Definitely. But then, like I think yesterday someone quoted, or this morning someone quoted Vinod Khosla saying that most of the 80% of the AI deals they've done in the last couple of months have been sub $25 million valuations, which to me is an interesting call out of, is that actually feels like I'd be curious, what are those types of deals? They're probably less infrastructure because they require less, capital.
Seems to be suggesting applied.
Yeah.
There's like, I'm with you completely on the idea that sort of there are various, call them, tiers or sectors within the AI market.
Yeah.
And some, like infrastructure, require maybe some capital investment, like a really, really high level of technical expertise. The valuations went high in 2023 and stayed high.
Yeah.
And then there are the rest of them. Like if I look across the SaaS category in Carta, I'd imagine that by one way or another, many of those companies are touching the AI boom.
Right.
They're doing it in more minor ways or automating a piece of things or whatever it is. And so like in general, I'd imagine that in another year or two, the SaaS median valuations and the AI median valuations outside of some really capital intensive stuff might be much closer than they were.
Totally.
And certainly than they were when ChatGPT kicked off the run in 2022.
Yeah, no, absolutely. I think it also leads to this question of like, which sort of like we've been reflecting a lot on, is like, where does the median valuation lie for sort of these non-AI first companies versus when you are an AI first company today, you're likely in infrastructure, but if you're sort of in the applied world, like what is the appropriate, I would say funding round size, but also valuation. I think something that I do think a lot about is AI in itself. The founders who are building, founders in general, you have to have obviously the conviction, but some level of delusion. I like to say like some amount of delusion.
I'd be shocked if the word "some" needs to be there.
Right,
a pretty healthy amount of delusion.
Very well, definitely a healthy amount of it, and I think that in itself has been driving so much. I mean, we obviously like VCs are also part of sort of the drive of the valuation and sort of the demand. But I've also noticed round sizes are larger, right? Today, you're seeing like the first seed round is looking at like a $6 to $8 million seed round. And I'm actually curious what your data says.
Yeah.
And these round sizes are getting larger. And with larger round sizes, I also find the delusional aspect of, the founder is like, there's also this awareness that like, in order to get to any milestone marker for revenue perspective or customer adoption, I need to spend an X amount on compute.
Yeah.
And therefore, I really care about the amount that I'm spending on compute. I also care the amount that I'm going to have to spend to acquire or to hire an engineer out of Google or Facebook or you name it to get me to get them to come over. Even OpenAI, right? They're paying a crazy amount in salaries to get people to come over. And then So you kind of bake it into like, hey, I'm trying to raise 5 to 6 million. Oh, FYI, I'm leaving my company on Friday. I still haven't left my company.
Right.
And then you're kind of, and most founders, I think, are still, historically, we've always said like, your first round of funding is where you give up the most dilution.
Yep.
And so maybe you're thinking like, anywhere between 10 to 20% ownership that is sort of 10 to 20% of the company is being diluted in that round. You're talking about like 25 to 35 million post-money valuation ranges, right?
Mm-hmm.
And that's, or caps if there's on safe notes. And that's sort of what we're seeing. And that's kind of market standard right now in that space.
Totally. There's, I would agree with you that the rounds, especially for like capital intensive AI, and capital intensive, it does a lot of work in that phrase, right? So there's a theory that AI is going to make it much cheaper to start a company.
Right.
And I think that's probably true, but then you have the countervailing force of hiring needs, expensive engineers, compute being more expensive. And then if it's easier to start a company, the spaces automatically become more competitive.
Yep.
So how do you stand out? You need funding.
Right.
So like we actually put out to this data the other day on the size of seed rounds and the likelihood based on a correlation between the size of those seed rounds and whether or not you made it to the A.
Yeah.
So a seed round of 2 million or less was statistically quite a bit less likely to make it to A. And so there's a lot of pushback on this, and I thought some of it was valid. So one theory is they didn't have enough money. They were trying to exactly do the round, exactly like cut it as lean as possible instead of giving themselves buffer.
Right.
The other is, well, better founders would have raised more. Or like more intriguing ideas would have gotten a bigger round. So maybe you're just doing the correlation wrong and it would have always ended up this way. I can kind of see both. But I do think that if you're building in a space that is going to be automatically more competitive than it used to be, there's still an advantage to cash. I mean, I know we're in this idea of VC lean, do one round and then never raise a
Sure.
I think some companies will make that work, but like fewer than are going to try it for sure.
Yeah. Let's come back to that one, but I do want to sort of comment on this point that you just made, which is I actually agree that if you raised the companies that raised less than 2 million, or you're raising a smaller seed round, less likely to graduate, primarily because I think the companies that are graduating from seed to A, closer to product market fit, not necessarily guaranteed product market, closer to product market fit, have some amount of, or are starting to show early signs of revenue, if not already have revenue. I think today there is a higher bar, and like people do require you to have revenue in order to raise your next round of funding. And then third is like these are founders that typically are mitigating for risk of it will take longer.
Yeah.
Right. So the person who, to the comment that the pushback was like, hey, maybe they didn't plan for how long it would take. That's actually a fatal flaw in the existence of the business.
Right.
Because if you don't have money, then you don't exist.
Right.
And so I think that the ability to sort of have the insight that, it's probably going to take us 18 months to get our product into market. And realistically, it'll be 24 because nothing ever happens in the time that you want it to. And actually, we need 2 more engineers than we expected to because we hired 2 through recruiting agencies that didn't end up working out, but we're still paying the recruiter fees because it was past the date. And then now we've added 2 more. So it's like the founder who is thinking 5 to 10 problems ahead already knows that they need $5 to $7 million. And that I think is like where I think your data is like actually proving that case. It's obviously hard. Like I do think that there's still a ton of pre-seed rounds getting done, but then it's like, can the pre-seed get a fast follow seed done or a fast follow big or from a seed to a sizable A?
Yeah.
Right.
If I was to place like the mix or the most confusing part of the market to us right now, even with the data that we have, it's definitely like mango seed to A range. Like there just seems to be all of these companies that are trying to break through to the Series A round. Jenny Fielding called this the Series A chasm, I think. But there's just so many companies that have had the expectations moved underneath their feet.
Right.
So the metrics they have to hit are much higher than they had planned for. And they maybe raised pretty sizable rounds back in the boom times, but they can't make those rounds last forever.
Yeah.
So they're coming up on some really big decision points. And it feels as though there are more companies trying to break through to that A than there ever have been. I'm wondering if at Upfront you have a perspective on like either bridging or extending current companies or like how you take a view on whether or not they're going to get to the A and then beyond.
Yeah. So we always pride ourselves on being like pretty long-term partners. I think with our first check-in, we typically keep, a decent amount in reserves to make sure that we can invest in follow-ons. But also we are prepared to be, as we're the first institutional check. We know that it takes more than just that first institutional check to get you off the ground.
Okay.
In some cases, it could take you another round. And, bridge rounds are in some ways like taboo. And in others, I think it's absolutely expected that you would need another round of financing in order to, so this scenario you just described, where the metrics have changed for a Series A, or it's almost like the venture expectations have changed, right?
Yeah.
And like, what does your next investor look at and what do they require? You as an early stage investor should be prepared and should be able to fund your portfolio company's needs. And
every single one of them? Or
no. And so this is where
choose amongst your children.
Totally.
Yeah.
And you do ultimately, you do have a decision-making matrix, right? Like we have a process by which we're like, okay, we look at our portfolio, we're doing the assessment pretty regularly, like how many will graduate and how many do we think need the support and how many do we say, unfortunately, we're going to walk away from. This is part of the venture capitalist job.
Absolutely.
Many venture capital firms don't do this. And that's when it gets harder, is like not cutting your losses faster. And you end up spending a lot of time. I was talking to a friend yesterday and they've sort of been a VC lawyer for a really long time. And they said, we've noticed that oftentimes the difference between a massive returner and not is that you ended up investing more dollars in the one that didn't work out. And you put less. And so even though you had like 1% of the decacorn, or not even 1%, you had 0.005% of the decacorn, it didn't make your fund because you unfortunately put a lot of money and put a lot of dollars into...
You doubled down on the wrong horse.
Correct. And it happens all the time. It's part of the job we're in. But I think there's like this awareness of, kind of knowing when to cut your losses. On bridge rounds, I just want to come back to that, is on bridge rounds, I think the way I think about it is they sometimes need to happen. I think I always come back to, is this a founding team that I want to continue working with? Is this a founding team that I believe in and has actually proven something with the initial dollars? Like we talk a lot about capital efficiency of every dollar. And then I think it comes into, is this one of the ones we're going to continue to support? If it's not us, then we want to help them to raise that additional round of funding. But I also think as VCs, we have a responsibility to have an honest dialogue with founders and say, hey, do you think this is working? If it's not, we're simply a mirror. At the end of the day, it's your decision to keep working on this or not. But ultimately, I think that every founder today who maybe is in the Series A chasm is having a little bit of a come to Jesus moment if things aren't up and to the right of, do I want to spend the next 15 years building when I've been told by everyone this is the worst fundraising market to be in, right? Yeah. It's also the sign of grit, and it's the sign of like real resilience that we're looking for, which isn't inherently in everyone. We've had a lot of entrepreneurs for the last like 3-4 years because it has been really easy to start a company, and capital was a commodity. Capital there's still a lot of capital out there. There's, a ton of dry powder, but it is more of a commodity. And to the point that you made on like sort of the one round, the cost of capital is way higher today than it was.
Yeah. Do you think that there is a theory under which that like desire to be a founder is related to the status of founders in society in various parts of the country? Like, gotta be honest, it's very high status to be a founder in San Francisco.
Absolutely.
So that probably just pulls more people to that, to instinctually try that route at least for a while, and then maybe they get knocked down by fundraising or other things. But
totally,
would that predicate towards the idea that founders in non-mature ecosystems want it more?
It's a great question. I think in San Francisco, if you say you're leaving to start a company, people congratulate you.
Yes.
They're like, well done.
You did it.
You did it.
You finally
did it. You made it. You're a big dog now.
Right.
You have, reached the Holy Land.
Well, the golden ticket is the YC entry.
Of course.
So there's the YC acceptance.
Yes.
You're like on the way.
Totally.
Yeah.
But in any other ecosystem, New York's a great example where I think like when people do it in New York runs on a different currency, right? It runs on a different currency. The transactions are different. It's sort of like, why are you an idiot to give up like a good paying job and be able to trade on so many other things? Here, it's like, why would you stay in a good paying job when you have the opportunity cost of your own brain
100%.
and time and like all these things?
Needs your talent.
Right. And so I definitely think it, is a little bit localized. At the same time, it attracts a certain type of person, a risk-taking appetite that is a little bit higher here. Now, interestingly, in other ecosystems, I'd be curious how many are raising venture rounds versus are using alternative forms of capital to sort of get their business up and going. And then I always go back to the example of Webflow. I think of Webflow as such an interesting company where I don't think they raised very much money in the early days, and they kind of built this massive business, and then they eventually raised a large round from Excel.
Yep.
Zapier is an interesting example too, where they raised a small amount of money and then have built this incredible business, right? It's now almost like every workflow automation business is sort of like connected, or the pipes are sort of built through Zapier. And, they just did, like, I think they've done some larger rounds of secondaries, but I think they're profitable. I think they're doing really well. These businesses, I think, took a different approach where growth was maybe, I can't speak to their growth numbers, but they had a different growth trajectory, and the way that they thought about growing the business, the way they thought about like sort of attracting talent. Was it all in the Bay Area? Was it all in the US? I don't know. I think Webflow might actually be a non-US incorporated company. Yeah. And so when I think about these things, I think I come back into so much of what we really look for in venture, and what we really are what we're kind of digging into with founders is like, how gritty, how resilient are you? And how much do you have to sort of eat shit to make it happen? Sure. Pardon my French, right? And can you really face the music, and can you really stop paying yourself and completely do that? Now, the flip side is that the founders in non-Bay Area ecosystems aren't as cushy. They don't have access to capital. They don't have access to all of the resources that you do here. Mm-hmm. And so therefore, they might actually be a little bit grittier. So I'm not saying that there's like one perfect ecosystem in which to build in. I think you're always looking for the exception. You're always looking for the exceptional. Yeah. And I think the biggest thing, it's funny, I have a bracelet that says resilience, because I fundamentally think that's it's the most important part of a founder's inherent abilities. Yeah. The last 5 years have shown us, the last 5 years have almost said resilience is not essential. Right. Because, it's not working, you can get another round done. Sure. It actually was the easiest thing to do, was to raise another round of money, right, or raise another round of financing. So now we're going to see what the real founders are trying to spend.
The tide has come out, and now it's kind of seeing who's swimming and who's not.
Yeah.
There's the other part of that that's pretty interesting when I think about my day job, which is, providing value, hopefully through our data to founders. Yeah. Some of the stuff that we promulgate as look, this market data is useful because it gives you the sense of the path through this, when in reality, there is no path. Yeah. It just feels more professionalized. It feels much like the idea, 10 years ago, you wouldn't have talked about pre-seed because that was just you were thinking about a company. Right. And then you got to venture when you were a fairly sizable business or a going concern. And then it's just all this professionalization has moved back and forth, and there's standard routes. I sometimes think that while they can be incredibly useful, they can also make people think this is a checklist, and I just hit every checkpoint, and then that's what being a founder is. Yeah. But it seems like fundamentally that it's the opposite. It's forging your own way. Exactly. And I think there's this authenticity to doing it in earnest, where you're I'm driven by a mission, I'm driven by a user experience I want to create, or an outcome or a journey. I mean, I think that's sort of how Henry came about thinking about eShares, and now Carta is sort of there was really deep thought and authenticity around hey, this is a problem in the world of how do you manage your stock certificates in companies, right? And it was sort of a messy experience, and sort of with the intention that he had and going out and building it. I don't know if he was I'm going to build an X billion-dollar business, or and as a reminder, valuations are sort of, the beauty is in the eye of the beholder. Sure. And at the end of the day, that 409A valuation is sort of essential, but more is the clearing price, right? Where it actually clears at. And so I think for founders who don't have the authentic drive to do what they do and are driven by the checklist, or what are the milestones that the data told me when I hit 2 million in revenue, I can now go then raise a Series A. The Series A gates open, right? Correct. And then you just have the conversations. But it's about picking among the term sheets that will come to you. Totally. But the best founders get it done. Yeah. The best founders are the people who get it done, no matter when the window is open or not. And they're building, there's real pull in the market. They have authentic credibility and are resilient, and
they're actually listening to users. Most founders spend a lot of time talking about user research and, the voice of the customer and like, how much are you hearing? But it's like, do you actually internalize that? I actually think that the work that you've been doing at Carta is a really good reflection of sort of like hearing what the customer wanted a little bit and hearing kind of what the market demands. I think a lot of this data is really essential to the rest of the world to understand, as well as Silicon Valley too.
Yeah.
But it's also like a good barometer and a good check to be like, oh, okay, so like there is normal out there.
Right.
Even though we hear about just the frothy headlines, there's actually like, a smoothing out of the curve that is taking place.
I think if there's one thing that we've tried to do with the insights practices in general, it's just to provide a reality.
Yeah.
And then not to say that you need to pinpoint a part on this chart and say, this is us, we're in the median. It's just like, okay, here is what the range, here's what the world looks like.
Right.
And then we can negotiate from the same terms, as opposed to reading the Mistral headlines and you're like, great. Oh, we're not raising $100 million. Maybe we should feel pretty bad about ourselves.
Yeah.
Because like we're just not playing in that ballpark.
Totally.
So
yeah.
It makes a lot of sense. All right. I have 3 speed round questions from you.
Go for it.
All right. Question number 1, a category that you think is overlooked right now and has a lot of opportunity left.
I'm going to say something a little bit lame, but it is AI oriented. But I think it is the application of AI specifically around diseases and like sort of detection of diseases early on, but also a little bit more around application in there's been a lot of work around like genome mapping and kind of the genetic research and genetic work that is happening. But I think the AI applications there are in their early innings, and there's so much that will be happening. Having been through enough health journeys myself and just like seeing what the implication, like the positive and the good of AI in that world will be. I'm not saying that it's completely overlooked and no one's spending time in it at all. I just think like mainstream tech is spending no time because you have to be a little bit more technical, but there is massive opportunity there that I think a lot of folks will spend time eventually.
Here. Yeah, can't come soon enough. Okay, second question. The most unique way that you at Upfront or that you've heard about another fund helping a portfolio founder.
So I actually think that this is I would hope that this is unique and that, this is something that people say that it's specifically to us. I get this feedback from our founders all the time. But I think it's something valuable that many people should be doing if they aren't already doing, which is I think founders look at board members or look at investors as a mirror, as somebody who's sort of reflecting back, but not necessarily directing, because I don't think it is our responsibility to direct. And where I think this plays out very interestingly is in hiring. And so I think something that is unique is founders will, or something that's like expected is founders will loop board members into hiring processes, but more specifically for the sell and be like, hey, we really want you to come work. Aditi at Xfont or at Upfront is doing a really great job and she's our board member. You should talk to her. She's going to do the sell. One thing that I've actually found is I was a product manager in my past. I've spent time building in product, and currently we're doing a product search for one of my portfolio companies. Something that I found pretty unique is I actually run the case study. Now, one could say, is it enough? Like, should I be doing that? Wow. Should I be spending as much time doing that? The founders and I do it together, and like we kind of like, it sort of throws candidates off a little bit, where they're sort of like, hey, that's an interesting way to like run a hiring process. But we've gotten feedback from all of the candidates that seeing your investor be as leaned in as they are and seeing your investor kind of really care about using not only their expertise, but also like helping come up with a plan and strategy of like how to actually recruit this person and then being involved in it has made a big difference. It's sort of selling in advance of selling. Yeah. And it's also reflecting back the culture and mirroring back to the founders the type of person they're looking to hire and the type of people that they are and who do they want to bring on. So I felt I've gotten feedback on it recently that people have found it very unique. Unique is hopefully like a good thing and not like a you eat glue and are a weirdo.
I mean, that's no shade to any glue eaters out there. This is a glue positive podcast.
Yeah, exactly.
But that's one, hadn't heard that before. Fascinating. But two, it brings up the idea. It's the idea that you would want to try to get across in Aditi's going to come and sell you without ever saying it.
Right.
You don't need to say it. It's like, she cares very deeply about this company, or she wouldn't be spending her time interviewing you for a position at a company she doesn't work for.
Totally.
Or does.
And I'm not asking you questions like, why do you think X company is such a great company? Or what can I tell you about it? It's more like, hey, let's talk about a practical use case of something we could build together.
Teach me about you as a product.
Yeah, exactly.
That's fantastic. Okay, last question. The number one question that you more founders asked you during the fundraising?
Yeah, so I actually have been pushing my founders to ask this of VCs when they are raising, which is, it's sort of, if you got feedback from your portfolio companies, what would be the most difficult feedback that you could receive? Or what are the areas of improvement? Or and this is sort of when your founder is at a position where they have a term sheet and they're kind of like,
This
they
is
have
the
ball.
intro call.
This is not in the intro call. This is when you have
Exercise some judgment.
Totally. This is when you have ball control, but it is, what should I know, or what feedback would your founders give you about the way that you've shown up with them, which is always helpful to understand the way that VCs work with their founders. And I would also always push on founders to do this, which is, you need to know what you are looking for. Most founders go into a process and they're like, I just want a term sheet.
Yeah.
That's all I want.
Yeah.
And turns out just wanting a term sheet doesn't set you up for success. Because yes, you only need one yes at the end of the day, because you just need that capital. And if you're in that position where you're like, there's nothing else out there and all I need is capital, then and you've gotten 100 no's, 200 no's, you get one yes. Okay, fine. Take it for what it is. But take it knowing the cost of it. Take it knowing what you're getting into. Because what founders don't realize, and like we've seen this happen now, and we're seeing it in the market, is you're signing up for a marriage with the investors, right? Whether they take a board seat or not, they're on your cap table. These people own part of what is your livelihood, what will be, one of your greatest outcomes, maybe one of many. But how do you, when you let this person sort of enter your world and enter your financial future, you need to know who you're getting into bed with. And I think that's something founders spend very little time doing, is like kind of knowing and identifying like what is it that they are looking for from their VCs.
Yeah.
So I always tell my founders to have that kind of question, have that rubric of what are they looking for. And then I always push them to ask VCs who've given them term sheets when they have multiple offers, hopefully in front of them, or even one, which is like sort of, what is the biggest piece of feedback that you get from founders? Because you got to know who you're working with.
Do you think that VCs, when they're asked that question, I won't say they're dishonest, but do you think that the way they answered is as important as the content?
Absolutely. I was going to say, you can figure out if someone's being genuine or not. And also, guess what? You as a founder can back channel these people and sort of like, get cross-reference on responses.
Yeah.
But if you don't actually, but I think the way you respond to that and the actual answer itself is probably less important as much as like the way the VC responds. And you can hear, and by the way, I say this to LPs all the time too. LPs should reference us, not just with the founders themselves, but they should ask us directly, like, hey, what would your founders say about you?
Yeah.
What are the biggest things that they would say you need to work on? Because if you can't be self-aware, you can't say you're perfect.
Sure.
I have yet to meet that person.
I'm sure you can.
I'm sure you can, but like I have yet to be that person.
Absolutely. Yeah. Well, I'm sure we would have 1,000 more questions, but I don't want to take up too much of your time. So thanks so much for coming in today. I appreciate it.
Thank you. This was awesome. And thank you so much for having this.
We'll do it again.
Yes, absolutely.